Hello, in this video we'll be talking about corporate taxation, specifically corporate operations. Now whenever I do a video on corporate taxation, it's always important to think about the big picture where this specific video fits into play when it comes to the life cycle of the actual corporation. So the first topic and the first item on the life cycle is corporate formation and contribution. Next would be corporate operations, the normal day-to-day operations, and that's what we're focusing on in this video. So the normal tax issues. Other corporate operations issues include distributions, redemptions, and stock distributions, which also merit their own discussion. Finally, the last topic is usually corporate liquidation because that's winding up the corporate affairs, and we consider the tax consequences of corporate liquidation. So let's go into the specifics of corporate operations. So the starting point I like to do with the normal corporate operations is to compare and contrast the individual tax structure, individual income tax structure with the corporate income tax structure. So on the left here, we have the corporate tax Form 1120 structure. On the right side, we have the Form 1040 individual structure. Now, what you're going to notice is there's some similarity, but there's lots of differences. So under the tax law, the way that the income tax rules under Subtitle A of the Title 26 of the U.S. Code, so the income tax subtitle, the general rules apply to all taxpayers. However, there are some differences that apply to specific taxpayers. For example, individuals might get certain deductions that only apply to individuals, like medical expense deduction or moving expenses, those kinds of things. Corporations also have special provisions that only apply to them. For example, the dividends received deduction only applies specifically to corporations. You're not going to see that anywhere else. So keep that in mind. But again, the main thing is that when you learn about income tax rules, the starting point is always the same rules. Section 61, what's gross income? Various exclusions. And you see that's both the case for corporations and individuals. So you'll see we have lots of similarity there in determining the gross income amounts. So that gives us gross income. This is where we start to have deviations. So when it comes to corporate deductions, there's no distinguishing factor between adjusted gross income or deductions for adjusted gross income, I should say, and deductions from adjusted gross income, also known as above and below the line deductions. So you'll see that for individuals, we have those differences. Deductions for AGI, and then we have itemized deductions, and then we have the qualified business income deduction, both deductions that are deductions from AGI. Again, deductions for AGI are also known as above the line deduction because it's above the line for AGI. Below the line deductions are itemized and the deduction for qualified business income that go below the AGI amount. Notice again, as I mentioned, that for corporations, there's no difference. If you have a deduction, it just reduces income. So we have gross income, and then those deductions will reduce gross income. Now, we might have those deductions at different places on the Form 1120, right? So we have the Form 1120 for the corporations, specifically C corporations, and individuals, we have the Form 1040. The Form 1040. So on the Form 1120, we'll reduce gross income with deductions, but again, we don't have that same type like the individuals where we have different types of deductions. Now again, for corporations, deductions might be in different places, but it still has the same effect. You might recall that from individual income tax, being a above the line deduction versus below the line deduction is important for two reasons. First, deals with limitations. There are limitations on below the line deductions that deal with AGI. You don't have that same case for deductions for AGI. The second is that when you have a below the line deduction, generally speaking, itemized deductions, not the deduction for qualified business income under Section 199A, it's the greater of the itemized deductions allowed or the standard deductions. You don't have that issue with the above the line. So again, we don't have that same breakdown and dichotomy with respect to above and below the line deductions for corporations. That gives us taxable income, which we have taxable income. We take away tax credits, we calculate our tax due, and we have tax due or tax refund. So there are some similarities, there are some differences. Now, the rest of this presentation is going to focus on the main differences when it comes to corporations versus the general rules. Specifically, types of deductions and other issues that only apply to corporations or have special rules to corporations. So that's very important to understand. So let's go ahead and take a look at that. So whenever I deal with an income tax issue, if I'm given a fact pattern, if I have a client issue and it's an income tax issue, there's always 5 questions that I look at. What amounts gross income, if any? What amounts deductible or credits, if any? What is the character of the attribute, so characterization? When is the amount included or deducted or taken as a credit? And who? Who must include, deduct, or utilize the amount? So here are the timing issues, the when question. Here are the characterization issues. And here are the deduction issues. Now, I do have some other discussion at the end of the presentation, but these are really the main highlighting points, the major differences when it comes to corporate taxation, corporate income taxation from the rest of income taxation. We're going to take a look at all 3 of these classes, when question, characterization question, and deduction question separately. So timing issues, we're talking about the when question. So the first thing that we need to look at is the accounting period, accounting periods. So most C corporations can either be a calendar year, which is January 1st to December 31st, or fiscal year end, which means other than calendar year. Depending on usually the type of business, different industries usually have different types of year ends. So for example, in the accounting industry, lots of businesses have June 30th fiscal year ends. You'll have some retailers that have year ends that might end at the beginning of the year, maybe around January, just because they have lots of stuff going on. Various types of industries. You might have a Halloween store that closes its books on October 31st, because that's when that's when its main business ends. So it's really a factor of the actual industry. Now, S corporations and personal service corporations are more limited. Okay, more limited. This is where I want to stop and talk about C corporations versus S corporations. So C corporations, as many of you know, are subject to double taxation. The double taxation element, the first level of tax is at the entity level in the Form 1120. The second level is at the distribution level. Now, C corporation is that normal general corporation that's subject to double taxation. S corporation, though, S standing for small business, and also refers to subtitle S of the income tax provisions. Only one level of tax allocated out to the owners. Same with partnerships, very similar structure for tax purposes. The C corporation, subject to double tax. The C doesn't really mean anything. What it means is it refers to subchapter C of the Internal Revenue Code. If I said subtitle S, by the way, earlier I meant subchapter S of the income tax provisions in the Internal Revenue Code. So S corporation, small business corporation, that's what the S stands for, also found in subchapter S for S corporation in the income tax provisions, and then C corporation found in subchapter C of the income tax provisions. So I just want to lay that out there. Because we're going to see lots of talk of C and S corporations throughout the discussion. So that's really the accounting period. Not too many issues. The idea there is that businesses can be either calendar year or can be fiscal year end, which is other than calendar year. Accounting methods, very important. The when question in tax is extremely important, especially when you're thinking about things like time value of money. A dollar today is worth more than $1 in the future. Same idea of tax savings. $1 of deduction today is generally worth more than $1 in the future. And the reason I say generally is because I'm holding aside issues like maybe the tax rates will change. Assuming the tax rates stay the same, taxpayers still in the same tax rate, $1 of tax savings today is worth more than $1 of tax savings in the future. So accounting methods affect that. There's 2 major accounting methods, but there's also some combination of those. We're just going to focus on the 2 main. There's the cash method, mentioned here, the cash method, and there's also the accrual method. So the cash method, the taxpayer includes in income any revenue when it's received in terms of cash payment. Records expenses when they're paid. The accrual method, which is the other type, so we have cash versus accrual. Again, cash, we record revenue when it's received, expenses when paid. Accrual, we record revenue or income when it's earned, you have an economic right, and then we record expenses when they're incurred. Okay, so there's a liability that arises with respect to that expense. Hasn't yet been paid out, but somebody has a right to that. So generally speaking, the cash method of accounting is unavailable to corporations, except for S corporations, corporations that are involved in farming or timber industry. Farming and timber sometimes get special carve-outs. Qualified PSCs. So you're wondering, what's a PSC? Personal Service Corporation. So lots of attorneys, lawyers, accountants that have businesses. If they create a business and it's a corporation, it might be subject to the Personal Service Corporation rules. And finally, the last one, corporations with average annual gross receipts of, and this is $25 million. $25 million or less for the most recent 3-year period. Now, the reason I have this blank and I have others blank in this presentation is because these numbers change frequently. At the time of this video, it's $25 million, but it could change in the future, so be careful. Check this number. So you go check this, but $25 million at the time of this video. In the past, it was a different amount. It's $25 million at the time of this video. So these are corporations that can get the cash method. Now, another thing. So if you're a C corporation, which is what we're focusing on when we discuss these topics, or any corporation really, you cannot get the cash method. Must be accrual method. You can get cash method if you're an S corporation, farming, qualified personal service corporation, or you have average annual gross receipts of $25 million or less for the most recent 3-year period when you're looking at, again, average, the average. Okay. Another item, corporations that maintain inventory. If you do the $25 million or less test over the last 3 years, but you focus on the gross receipts. So if gross receipts are are more than $25 million for the last 3 years averaged, and you have inventory, you're required to use the accrual method. Required to use the accrual method of accounting. Required. Okay, so that's another example where you must use the accrual method. If you aren't required to use the accrual method, you have the option of doing the cash or the accrual method. You have those options. So that is the cash versus the accrual method. Okay, so now we're moving from timing issues, the when question, to characterization issues. So as I mentioned, the best way to understand some of these major points when it comes to corporate operations is many of you already know the tax consequences for individuals and how that works. So we're going to be addressing the corporate by focusing on the individuals and then kind of saying what's different. So capital gains and losses, everybody's favorite topic. And the reason why is because many people know that capital gains and losses can create preferential, if it's a long-term capital gain, can create preferential tax rates. This has historically been the case. So individuals, they do get the long-term capital gains, so net long-term capital gains, they get the benefit of preferential rates. So this could be at the time of this video, but this could be different when you're watching it. At the time of the video, the highest ordinary tax rate is 37%, and the highest long-term capital gains rate, not including the net investment tax issue, is 20%. So you're talking a 17% reduction in taxes. Big difference. When you're dealing with $1 million, that's $770,000. It's a big difference in taxes. So that's one thing. But let's go down the list. So individuals, capital gains and losses, the rules are capital gains can be offset by capital losses. A net short-term capital gain is subject to regular ordinary tax rates. And net long-term capital gain is subject to preferential tax rates. Again, we just talked about that. Now, net capital losses for individuals, after offsetting capital gains, you can also use up to $3,000 against ordinary income. I have this amount here because, again, it could be different. And also, there's also two numbers. $3,000 for general rule for taxpayer, unless you're married filing separate, and that's $1,500 against ordinary income. And the remainder carries over to future years. So a carry forward. So we've got this special amount here allowed to offset against ordinary income. Now, carryovers do not lose their identity. So if you have a long-term capital gain from a transaction, if you have a long-term capital loss, my apologies. If you have a long-term capital loss, and you use against ordinary income, but you still have some left over, it's going to remain a long-term capital loss when you carry it over next year. Same with short-term capital loss. Maintains that short-term capital loss character for next year. So very important. If we look at corporations, so the first thing is that capital gains still offset capital losses. That's the same. But here's where we change. Corporations are, everything in a corporate tax is subject to the same rate or rates. It's all subject to the same corporate tax rates. There's no preferential treatment for long-term capital gains like we had for individuals. Whoa, big difference. Yes, it is a big difference. And that's very important to understand. Corporations do not have a special characterization, long-term capital gain, short-term capital gain, long-term capital loss, short-term capital loss. It's all treated the same like ordinary income. Now, you might be wondering, well, why do we even worry about capital gains, capital losses for corporations then? Why don't we just classify everything as the same character? That's a great question. The reason why is, as you know, capital gains can only be offset by capital losses. So we're not able to basically commingle the ordinary income with the capital losses and offset it. We carry forward those or carry back those separately. All right. Another thing, corporations do not get that special benefit where you're allowed to offset against a certain amount of ordinary income. We saw for individuals it was $3,000 unless you're married filing separate, $1,500. Guess what? Corporations do not get that. They only can use capital losses to offset capital gains. Whoa. Okay, big change. Big change, but that's important to understand. Another thing, individuals carried forward all capital losses, whether it's short-term or long-term, carry them forward indefinitely until the person dies, and then they're gone. For corporations, we carry them back 3 years and carry them forward 5 years. So carry back 3, I left this blank, carry back 3, carry forward 5. And then all carried over losses are treated as short-term capital losses. So all capital losses that are carried back, carried forward, treated as short-term capital losses. Very important. Okay, very important. So that's a change as well. All right, one of my favorite topics, the dividends received deduction, the DRD. Not to be confused with DDR, right? Dance Dance Revolution, very popular game. I myself have enjoyed that game a little bit. Dividend received deduction. What is this all about? So if a corporation, has to be a corporation, okay, has to be a corporation. If a corporation owns stock in another corporation, key in on that. So a corporation, we usually denote that by a square or rectangle. It's a rectangle. So we'll say Corporation A. I know my rectangle kind of looks like part of the state of Oklahoma there, right? Sorry about that. It's supposed to be a rectangle. If Corporation A owns 100% of Corporation B, and Corporation B pays a dividend to A, let's say a $1 million dividend, the issue there is that there's 3 levels of tax. B pays tax, the first level, on the Form 1120, B's 1120, distributes that out, okay? When A takes that in, Corporation A takes that in, that goes on to A's Form 1120 as gross income. That's the second level. And then guess what? If A distributes that out to A's owners, let's say they're individuals, that's going to be a, boom, third level of tax. Oh my, we've just gone from double tax to triple tax. So in order to alleviate more than double taxation, Congress created this rule, the dividend received deduction rules. And these rules, what they're going to do is they are going to provide the ability to lessen that more than double taxation. Now, we do look at the ownership. Again, a corporation here, A owns B. Corporation must own stock in another corporation. We look at the ownership. That's important. If it's less than 20%, it's going to be a 50% deduction percentage we use. If it's between 20% and less than 80%, we use 65%. And if it's 80% or more, which we know as control in the corporate tax rules, remember, 100% deduction percentage. We're going to use that percentage. We're going to include in our income. So A is going to include the $1 million in income, in A's income, but A gets a deduction later on down the Form 1120, depending on the percentage, based on that dividend. Okay, so now we've gone through and identified really the timing issues, the deduction issues, and the characterization issues. Again, those are the really big differences when it comes to corporate versus individual tax. There's lots of other differences out there, but those are the main ones. Those are the big ones, okay? Real big topics. Again, now, take a look at Form 1040 versus the 1120. You might actually want to stop at this point. Remember, corporations file Form 1120, specifically C corporations. Individuals file Form 1040. Go stop the video. Take a look at Form 1040 versus the 1120. Again, you're going to see lots of similarity. The structure and labeling might be a little different when you look at these forms, but you're going to see extremely similar. Things, though, start changing when we get to the NOL and the DRD, right? Those types of deductions are unique. These are unique for corporations versus individuals. And remember, individuals, though, we've got deduction for AGI, and then we have the itemized, also known as deduction from AGI, also deduction for qualified business incomes, and also deduction from AGI above versus below the line. We don't have that here. So there are some differences when it comes to corporations versus individuals. It's important now to kind of dwell on like what you just did. You kind of shedded light on some of those major differences, and you apply the rules that you've already learned with respect to income taxation, but now you're focusing specifically on the major differences for corporations when it comes to operations. Okay, corporate tax rate and procedural issues. So currently, in the time of this video, the corporate tax rate is 21%. However, when you're watching this in the future, it might be a different percentage. So please pay attention to that. In the past, corporate tax rate has fluctuated. It's gone all over the place. Okay, a few years ago, it was 35% progressive rate structure. But currently, at the time of this video, it's a flat 21% rate. Next thing, alternative minimum tax. You all know what the alternative minimum tax from individuals. Alternative minimum tax for corporations at the time of this video is no longer relevant. It's no longer applicable to corporations. It is relevant, though, to individuals. Consolidated returns. So, consolidated groups. Entities that own other entities. We saw examples with Corporation A owning 100% Corporation B. Well, when you have consolidated groups, one corporation will have to report another corporation with a parent 1120 and we have subsidiary 1120. I'm not going to go into those specifics. That merits itself its own discussion, but we're not going to talk about that here. But it's important to understand because if you have a corporate group, you might have to have everything flow through to the parent corporation return 1120. Filing requirements. We just talked about this, or we've talked about this throughout this presentation, but let's continue to talk about it. So again, C corporations file Form 1120. It's due on the 15th day of the fourth month following the close of the tax year, even if no taxable income. Now check that amount or check that date because in the future it might change. It's changed in the past. So for example, calendar year corporation would have to file by April 15th of the next year. Okay? Now, an automatic extension of 6 months is available through Form 7004. This is an extension to file, not to pay. You still have to pay on time. This is an extension to file. Speaking of paying estimated tax payments, corporations, just like individuals, must make estimated tax payments quarterly and all that stuff. Must make estimated tax payments equal to the lesser of 100% of corporation's tax for the current year or 100% of tax for preceding year. And there's no estimated tax payments required if tax liability expected to be less than. That amount fluctuates. It's been $500. It's been different amounts. Check that amount, but just note that that's an issue. All right. The last thing I want to talk about is Schedule M1 versus Schedule M2 versus Schedule M3, which really deal with filing requirements. So we have the 1120, okay? And the Schedule M1, M2, and M3. And by the way, the M1, M2, and M3, these also apply to not just C corporations in Form 1120. They might be on an S corporation, Form 1120S, Partnership 1065, but we're talking about specifically C corporations here. So a Schedule M1, let's start with the M1, okay? The Schedule M1 is where a corporation reconciles financial accounting income with taxable income. The idea here is that you have book financial accounting income, net income, and you have taxable income, okay? And the idea is that you report that book income, but then you have taxable income of different amount. Well, the IRS wants to know, why are there differences in the amount? So the key here is showing those differences. It's all about transparency. If you have aggressive positions or you're showing something, why something's different from your financial accounting income, well, guess what? IRS wants to know why that's the case. So we have what we call differences. We have permanent versus temporary. Sorry. Let me respell that. Sometimes my spelling is not the best. Permanent versus temporary differences. Okay? Permanent versus temporary differences. So an example of a permanent difference is something that either for book purposes or tax purposes we do, but we don't do for the other, and we're never going to reverse that. So perfect example. Municipal bond interest, not included under tax income. However, it is included on the financial accounting books. It's reported as income. That's something that's never going to reverse. However, a temporary difference is something where it will reverse over time. Perfect example is depreciation. Most businesses, for financial accounting purposes, do straight line for everything, whether it's equipment, machinery, trucks, building, not land, right? Not land. It's all straight line. However, as you know, makers depreciation, a lot of assets could be 200% double decline balance or 200% decline balance or 150%. Some assets, of course, like buildings and others, could be straight line, like amortizing intangibles, straight line. But some assets, double decline balance. So from a expense standpoint, earlier on, if you have assets that have double decline balance, you're going to take faster depreciation early on, but straight line will be higher later on because you're going to have lesser depreciation later on. Because the idea is that over time, it's going to be the same amount of depreciation. The only thing that's going to differ is going to be with respect to when it's taken, the when question. So a temporary difference reverses over time. So for tax purposes, you might have lower taxable income because you've taken depreciation and you have obviously double decline balance, but then for financial accounting purposes, you do all straight line and boom, it's going to be recovered ratably over time and you have less depreciation early on, but more later on. So it will reverse. So I talk about all these things here, common reconciling items, and they're all reported. Now, this is important. An M1 is required. Let's go by not required. An M1 is not required for corporations with less than, and this changes, but right now it's $250,000 of gross receipts and less than $250,000 in assets. So if you have less than both of those numbers, gross receipts and total assets, then you do not have to file an M1. That's not many corporations. Most of those have one of those that's $250,000 or more. So that means pretty much all corporations must file Schedule M1, at a minimum. We're going to talk about M3 in a moment. Okay, next, M2. Schedule M2 deals with reconciling retained earnings, which is a financial statement item at the beginning of the year with retained earnings at the end of the year. It shows what the differences are. Now, Schedule L, which is the balance sheet, and M2 on Form 1120 are not required for corporations with less than, you got it, $250,000 of gross receipts and less than $250,000 in assets. Same idea. Again, that means that almost all entities are going to file M2. M2. Because if you have $250,000 or more of gross receipts or $250,000 or more in assets, guess what? You're required to do M1, M2, Schedule L. And the Schedule L, the M2 deal with one another because M2 deals with retained earnings. Retained earnings go on the Schedule L balance sheet. Finally, the last item, and when we're done with our presentation, is the Schedule M3. So the Schedule M3 is similar to the M1, but much more detailed. So here are some common examples you'll see when it comes to taxpayers. You'll see a taxpayer of an M1 and an M2, but maybe no M3. You'll see a taxpayer with all of an M1, part of an M3, and all of an M2. Or you'll have an M2 and an M3. This is usually what you see because, again, not too many taxpayers don't have any of these. That's usually the three you see. So what's common here? M2. All of these have an M2, right? M2 is, again, reconciling beginning of the year with end of the year retained earnings. Shows how that's reconciled. So that's going to be obviously very important, That's That's the M2. But the M1 and the M3, they kind of do the same thing. They reconcile book income, book net income, right, to taxable income. The idea, though, is the M3 is much more detailed. So it's even greater transparency between the corporate financial statements and tax returns. And it helps the IRS identify corporations that engage in aggressive tax practices. So it's basically the M1, but even more detail. Okay? You just don't lump certain things together like you do with the M1. And you go, by the way, stop the video right now. Go look at the Form 1120 M1. Also go look at the Schedule M3, which is an attachment, and take a look and see how it differs. Now, the idea here, again, M3 more detailed than M1. If the entity has total assets of $10 million or more, so at the time of this video, $10 million or more, that's the first line right here. The entity is required to report much greater detail and do the M3, okay? We have to report the Schedule M3. Now, here's where it comes down. Here's where this situation make a difference, okay? So you can do either the full Schedule M3 if you have $10 million or more, or you can always do that. You can always do M2 and M3 like this. Or you can do all of the M1, which is what we have here, and part of the M3. You don't have to do all of it, but there's part of it. I'm not going to go into the details, but there's part of the M3 you must file. If total assets are between $10 million and less than $50 million. Once total assets are equal to or more than $50 million, full M3 is required. So that means that this is greater than or equal to $50 million in total assets. Some of you might be wondering, why not look at total or the receipts? That's usually because if you have total assets of $50 million or more, then you probably have a pretty good amount of receipts too. Maybe not the same amount of receipts, but we're focusing on assets here, okay? Focusing on assets. So, again, let me clarify this. If you have less than $250,000 of gross receipts and less than $50,000, start over. If you have less than $250,000 of gross receipts and less than $250,000 of total assets at the end of the year, or any point during the year, I should say, any point during the year, then you do not have to file Schedule M1, M2, M3, Schedule L, none of that stuff. Very rare though, very rare. A lot of businesses have $250,000 or more of one of those categories. If you have $250,000 or more of one of those categories, you must file M1 and M2 together, and the Schedule L, which goes along with the M2, by the way. It's the balance sheet, which relates to the M2, because that's where you show retained earnings, and you have the balance sheet at Schedule L. Once your total assets get to $10 million or more, you are required to file M3 in some way, somehow. If you have between $10 million but less than $50 million, you can do all the M1, part of the M3, parts of it, which again, there's required parts of it. Okay, I'm not going to go into the specifics. And you have to do the M2. You can always just elect and do the full M3. You can always show more detail. But once you hit $50 million of gross receipts, total assets. See, you got to be careful here. $50 million of total assets. You are required to do the full M3. You can still do the M1, but you at the minimum have to do the full M3 and, of course, the M2. So I hope that helps you understand. If you're having any trouble understanding, again, what I always recommend doing when it comes to these normal operations issues is go look at the forms. Take a look at these issues, okay? Dig deeper into these issues. Of course, this is a basic discussion, but at least it sheds light on the corporate operations, the normal operations.